Jake finally decided he's ready to invest. He opens a finance article. And 5 seconds later, boom, index fund, ETF, mutual fund, hedge fund. It feels less like investing and more like decoding a secret society. Are these different strategies, different companies, different levels of risk, or just different ways to say the same thing? If you've ever felt that confusion, good, you're normal. Today, we're breaking it all down. No jargon, no finance degree required. By the end of this video, you'll understand what a fund actually is, how index funds, ETFs, mutual funds, and hedge funds really differ, and which type fits which kind of investor. This isn't financial advice. It's investing, simplified. Let's start with the foundation. What is a fund? Anyway, before we compare the types, we need to answer one basic question. What is a fund? Imagine you and 1,000 other people want to invest. Instead of each person trying to pick 20 perfect stocks, which, let's be honest, can feel like throwing darts blindfolded, you all put your money into one big pool. That pool of money becomes a fund. Now that fund can buy dozens, even hundreds, of investments at once. Stocks, bonds, maybe real estate. You don't own every stock individually. You own a slice of the entire basket. If the basket grows, you grow. If the basket drops, you feel that too. Simple idea, right? Funds exist because diversification reduces risk. Instead of betting everything on one company, you spread it out. Now here's where it gets interesting. Not all funds are managed the same way. And that's where the differences begin. Index funds, the quiet wealth builders. Let's start with the simplest one, index funds. Here's the core idea. Instead of trying to beat the market, just copy it. Picture the stock market like a giant orchestra. An index fund doesn't try to pick the best violin player, it buys the entire orchestra. For example, the S&P 500 tracks 500 of the largest US companies. An S&P 500 index fund simply mirrors those same companies in the same proportions. No guessing, no daily trading, no dramatic decisions. That's why index funds are called passive investments. They don't try to outperform the market, they aim to match it. And here's the part beginners love, because there's no expensive team constantly trading stocks. Fees are usually very low. Lower fees mean more of your money stays invested. Over decades, that difference compounds. And compounding? That's where wealth is built. Index funds are often bought and sold at the end of the trading day at a set price, so they're steady, predictable. They're ideal for long-term investors, retirement accounts, people who don't want to watch stock charts daily. Think of index funds as the slow cooker of investing. Not flashy, but incredibly effective over time. Now, what if we made that same idea more flexible? Enter ETFs. ETFs, the flexible hybrid ETF, stands for Exchange Traded Fund. Sounds technical? It's not. An ETF is basically a fund that trades like a stock. That's it. Like index funds, most ETFs hold a diversified basket of investments. But unlike traditional index funds, ETFs can be bought and sold throughout the day. Real-time pricing, market hours flexibility. You want to buy at 10:32 a.m., you can. Sell at 2:15 p.m., also possible. That flexibility attracts many investors. Another advantage? ETFs are often tax efficient. Without getting too technical, their structure can reduce certain capital gains distributions compared to some mutual funds. That means potentially fewer surprise tax bills. Fees are usually low, accessibility is high, and you can start with just one share. There are ETFs for almost everything. Total market, tech sector, international stocks, bonds, even niche themes. But here's something important. Flexibility can be a double-edged sword. Because ETFs trade like stocks, some people treat them like trading tools instead of long-term investments. And frequent trading can quietly eat into returns. Used wisely, ETFs are powerful. Used impulsively, not so much. Now let's shift gears. Because not all funds are passive. Some try to beat the market. That's where mutual funds come in. Mutual funds, the active approach. Mutual funds also pool money from investors, but here's the key difference. Most mutual funds are actively managed. That means there's a professional manager or team deciding what to buy and sell. Their goal? Outperform the market, beat the index. Sounds appealing, right? Why settle for average if someone can deliver above average? Well, here's the trade-off. Active management costs money, research teams, analysts, frequent trading. That means higher fees. And even a 1% difference in fees might sound small, but over 30 years, it can mean tens or hundreds of thousands of dollars less in your account. Another difference, mutual funds don't trade all day. You place your order, but it executes after the market closes at the fund's net asset value, NAV. That structure discourages day trading. which honestly isn't the worst thing. Mutual funds are often used in employer retirement plans, actively managed strategies, certain bond portfolios. They offer professional oversight. But research consistently shows that over long periods, many actively managed funds struggle to outperform low-cost index funds, especially after fees. That doesn't mean all active managers are bad. It just means beating the market consistently is extremely hard. Now, if mutual funds are professional drivers, hedge funds are race car drivers. Hedge funds, the high-stakes arena. Hedge funds operate in a completely different universe. They are not designed for everyday investors. Most hedge funds are only open to accredited investors, meaning high income or high net worth. Why? Because hedge funds use complex, aggressive strategies. They don't just buy stocks and wait. They might short sell, bet on prices falling, use leverage or borrow money to amplify bets, trade derivatives, make concentrated high-risk plays. They aim to generate high returns, regardless of whether the market is rising or falling. But with higher potential return comes higher risk. The fee structure is also very different. Traditionally, hedge funds charge something like 2% of assets annually plus 20% of profits. That's called 2 and 20. It can be extremely profitable for managers, but not always ideal for investors. Hedge funds have more freedom, less regulation, more creativity, but also more volatility. They're built for investors who understand complex strategies, can tolerate large swings, can afford potential losses. For most beginners, they're not necessary. Exciting? Maybe. Essential? Not really. Putting it all together. Let's simplify everything. Imagine 4 personalities. Index fund, the steady, disciplined long-distance runner. ETF, the flexible multitasker, efficient and adaptable. Mutual fund, the professional strategist trying to outperform. Hedge fund, the aggressive risk taker chasing big wins. Which one is best? That depends on you. If you want simplicity, low cost, and long-term growth, index funds and ETFs are often the foundation. If you believe in active management and don't mind higher fees, mutual funds may fit. If you're wealthy, experienced, and comfortable with risk, hedge funds could enter the picture. But here's the truth beginners need to hear. You don't need complexity to build wealth. You need consistency. You don't need secret strategies. You need time. Investing isn't about finding the most impressive sounding product. It's about matching your strategy to your timeline, your risk tolerance, your financial goals. Because at the end of the day, the most powerful force in investing isn't leverage, it isn't timing, it isn't prediction, it's patience. If this cleared up the confusion around index funds, ETFs, mutual funds, and hedge funds, that's the goal. Finance doesn't have to feel like a foreign language. If you enjoyed this breakdown, hit like and subscribe. It helps more people discover simple, no-hype financial education. And I'm curious, which type of fund are you using right now, or which one are you considering? Drop it in the comments, because the more we understand the tools, the smarter we become with our money. See you in the next one.